An event at DU where everyone just got quiet on their own. So thank you for that and welcome. I'm Naomi Boyd. I'm the Dean of the Daniels College. I also serve as Chief Economic Advisor to Robinhood. And we're here tonight to talk about innovation and the future of private markets. So sort of to kick us off and talk a little bit about like the why of what we're going to be discussing. I'm going to tell you a little story. So when I was a doctoral student in Washington, D.C., I was working at the Commodity Futures Trading Commission, which is the chief regulatory authority for derivative markets in the office of the chief economist. And here I am, just this like little PhD student tolling away. And all of a sudden, our chief economist comes running into my office and says, what is happening? Who is the Intercontinental Exchange? Why have they entered the market? We have no oversight over them. We don't know what's happening. And it was just like, I don't know, but I'll find out. And so I think that oftentimes that's how innovation starts, right? It happens in a continuum. And sometimes innovation sneaks up on us. Sometimes we change structures to allow for innovation to happen. But I've seen over the course of the last 20 years, it started with electronification. We moved into market fragmentation. Financialization of commodity markets also happened. So what that means is that investors were able to use it as an asset class in their portfolio. We had the whole fintech revolution. And here we find ourselves talking about private markets, which is super interesting and very relevant. And so to kick us off, I would just like my fellow panelists to introduce themselves, and then we're going to get into a conversation about what is this about, what does it mean to have innovation in capital markets broadly, and really get into the nuance of the private market.
Yeah, thank you very much. Nice to see everybody. Thanks for coming out tonight. My name is Pat Dunn. I'm a Senior Director of Customer Experience at Robinhood, and I also lead our concierge services team, which we work with the high net worth all day long. But in the 5.5 years I've been at Robinhood, I've had a really unique view into how investors approach risk, how well educated they are, and just the abundance of information. And I've really seen this transition over the 21 years of my career of just how sophisticated what I would call the average day-to-day investor really is. And I'm just extremely excited to sit up here with these brilliant people and talk about a topic I'm very, very passionate about. So,
thank you, Patrick. Thanks for having me here. I'm Charles Fred. I'm the CEO of a company called TrueSpace. And by inherent to the name, TrueSpace is that we help companies that are past the startup yet to scale, those that are building a business versus starting one. We represent, through our data set, about 2.3 million private businesses in the United States, small to medium-sized businesses. And by doing so, in the last 10 years, we've been able to build a data set and a scoring mechanism that's similar to FICO, only it's a index that looks at the company, not the individual. And the whole idea here is that we can redirect or direct capital to these companies that have been overlooked. So the big idea we have is that we believe deeply that even though these companies need capital, what they need more is discovery. It's harder to get discovered than it is to get capital. And if we can change the game for discovery, we can actually make a big difference. So I'm happy to be here, happy to represent those companies today. And thanks again for having us.
Thanks. John Sebesta, I'm the Director of Entrepreneurship here at the University of Denver. I'm also working with Naomi to establish more of our work around private markets, and I've done a fair amount of research regarding how capital flows to those early stage companies, who it flows to, and who is left out of that process.
Great. Well, thank you all for joining me today. So when from a professor standpoint, an academic standpoint, when I think about capital markets, and I'm teaching students about capital markets, I always start with Jensen and Meckling theory of the firm, right? And it's really about how is capital flowing to entrepreneurs, and that's really why we have entrepreneurs on this stage. Is the health and welfare and economic prosperity of society really depends on capital flowing to the best projects and the best entrepreneurs and the best businesses. And for, if capital markets failed to exist, if they ceased to exist, it would be back to like knocking on doors and asking friends and family for money. So that sort of is the basis, the foundation of, how an entrepreneur can get funding. It really is like, okay, if capital markets don't exist, I'm gonna have to go and pick up the phone and knock on some doors and find this money. But capital markets do exist, and it allows for so much innovation and prosperity in the economy, and so much growth in terms of access. Democratization of financial markets is at the core of where Robinhood has sort of entered into the market. But I think fundamental to this conversation is really like, what is a public market versus what is a private market? And so I'm going to kick this over to John to really kick us off thinking about how capital markets, why capital markets exist, but really what are the differences between those two?
All right, so and this is especially for some of the students who may not be as familiar, but many of you may know quite well what the difference between private and public markets. But if we start with private markets, these are companies that the securities or the ownership of those companies is held closely within a small, typically a small group of people or investors. And when you are buying into the equity, you're buying into the ownership of those companies, or you're investing in them, the capital goes directly to the company, and you receive equity in exchange. You receive ownership shares in those companies. As long as you remain a private company, typically your reporting requirements are relatively minimal. On the contrary, we have public markets and public companies. Once you have grown, so when we start out as entrepreneurs, we typically are knocking on those doors, calling our friends and family, trying to find some cash. And then as you grow and scale, in order to gain access to additional capital markets, historically, you've gone through an initial public offering, which is when you take the shares, the equity in your company, and for the first time you list that on a stock exchange, the NASDAQ, the New York Stock Exchange. And at that point, anyone can purchase equity, can purchase shares of your company. And they do that instead of directly from you, they do it on a secondary market where they're buying and selling them between other investors. And so those shares can trade without having any impact on you as a company and your capitalization.
So the trend that we've started to see is that we are seeing less and less companies go public. And in fact, many companies that were public go to private. And so, maybe Pat, you could take this question around, like, what do you see as the benefit for a company that just went, that maybe went through the public offering process, but now has decided to go private?
Yeah, I think, for me, and at first point, I think since 1996 to now, there's half as many public companies as there were back then. And so you are seeing this direction, and it really is increasing the inequality out there. If you think of the accredited investor rule, what you have to be to invest in these private companies, once they move that direction, you're talking, it was $1 million plus. It was, to me, an arbitrary number that maybe made sense in 1982. You had to have $1 million, or if you're single, $200K in revenue or in income, $300K for married. So it really keeps it's 80% of our population unable to partake and invest in that. So when they're going private, yes, they get easier reporting requirements, but they also lose access to a lot of the capital pools that you would see in our capital markets, our private markets that are out there today. So for me, at the heart of wanting to democratize things, I think it's time that we really start to take a deeper look at this rule, ask ourselves in this day and age of information and access, should we really be holding out 80% of our population and letting the remaining 20% really thrive in that space? Because it's not only cutting it in half, but it is, you're seeing, I think it was a stat, 483 basis points if you look at how much better they have done performance-wise, private companies, versus public since 2000. So I think there's a lot of reasons they go private, but it also is to the detriment, in my opinion, of 80% of our population out there.
Right. And at the end of the day, as we sort of look at the historical relevance of access to markets, but also the wealth distribution, I think it's really important you touched on this, Pat, from a societal impact perspective, to allow your average American to participate in markets that they haven't been able to otherwise.
It's at Robinhood, what we really believe in is giving people the ability to invest in things that they like, that they know and they love. If you really look back at these companies that have just sat in the private space, much less have gone private, but just sat, everything that we use every day, Instacart was one of them, Airbnb was one of them. If you're looking even today, the Anthropics, the OpenAIs, the SpaceX for Starlink, just all these companies are just sitting for a very long time. And what I would really love to see is those companies that we know, like, and love, and that we engage with every day, let's allow people to at least get some exposure and partake in the same side of as all the rich people.
Yeah.
Yeah. Back in the day, it was 4 to 5 years from VC, 4 to 7 before you went public. So from your first VC investment, it used to be between 4 to 7 years that you'd go public. Last year, I think it was 13 years, 12 or 13 was the average.
Yeah. So we've talked about, establishing a framework for access from the investors' side of the house. But Charles, you work with second stage entrepreneurs all the time that are having problems receiving funding, or maybe you can talk us through a little bit about, from an entrepreneur's perspective, why would having greater access to resources or help in regard to spurring more economic growth?
I've been waiting 15 years to have this discussion.
I'm so glad.
Yeah, I've built 3 businesses, been lucky enough to find a buyer for that, but if they ever cut my body in half as a tree, you'll see these dark circles in the rings, right? And most of them had to do with access to resources and capital, and how difficult that is in a private marketplace. And playing by the rules, those of you that are building businesses today, you'd want to tell people about your business, but there's really no mechanism for it. The qualified investors that we've been talking about today are the ones that are looking for the 1 or 2% of businesses that are growing at these incredible rates. But the rest of us are growing the economy in the US. 40% of the nation's workforce works for companies that are not unicorns, but they still need capital, and just imagine if they had capital. So the big idea for us is transparency that's now enabled by AI. We have the capability today to see inside of a private company. The same capability we had over all these years in a public business, where you could literally pull across their reports, their quarterly reports, regulations, all those things that are there. And I don't think the private business owners have ever shied away from transparency. Maybe the great big ones do, because there's so much complexity in there. But if you're running a $15, $20, $30 million business, you're more than happy to share what's happening inside that business. You just don't have a mechanism for it. And that's really what we're trying to do at TrueSpace. We now have a scoring mechanism that can see 12 systems in your business the same way we see 11 systems in the human body. Your endocrine system, digestive, nervous, and such, and we can see those systems inside your business. You can report on those every month and every quarter, and we can get longitudinal data sets on companies that really want exposure. They want to show you what they've been building. They want access to capital. So that's why we really believe that it's not an access to capital problem in the private markets. It's how much time it takes and the cost of discovery. And what if we could change that? That's why I love sitting next to you today, because you guys have really interrupted a place that's literally had almost a locked door for private companies to get access to capital. And I think there's a lot of capital that would flow if we could start showing transparency. Imagine today, for example, if you could look at private companies and trust the data, trust the financials, trust the patterns, trust the growth plans. You could see them. What if you could do that? Would you invest in them? More than likely you would. So that's what we're trying to build today, and I think it could change so much in this private market.
Great. Charles touched on this a little bit, but you and Melissa Akaka, John, have been working on some research on access to capital and across different groups. So maybe you could give the audience a little flavor of maybe some of the hurdles that entrepreneurs face, not just simply getting their name out there, but talk us through your research and.
Yeah, absolutely. So to Charles' point, becoming discovered and becoming trustworthy is, I think, a huge challenge.
Yes.
That the capital flows through a relatively close group of investors who tend to know each other. They work together, they syndicate, or they come together to structure the deals. And the investors that we spoke to who are trying to find new companies and trying to discover those who are creating different types of businesses, even they were saying that they're completely closed to cold outreach. And so if you as the founder want to become discovered, want to find that investment capital, they're going to ignore you unless you come through their networks. And so it is a highly networked industry, and they're looking for the types of returns that Charles was just mentioning, where you have to be able to, in the venture capital world, when you invest in a company, you are looking for every company that you invest in to be able to return enough to cover the whole fund, which means that each company has to be able to provide a return of 40 to 100 times the invested capital. It's less than 1% to 2% of all companies can actually achieve those types of growth rates. And so many entrepreneurs are starting businesses knowing that they need capital, but not recognizing that the capital markets that exist at the earliest stages are not structured in a way that's supportive of those business models.
Mm-hmm.
So, yeah, those are some of the major challenges we saw.
Yeah. And essentially what this means is that the market has frictions, right? There are barriers to entry. Mm-hmm. And over the course of the last 30 years, there have been multiple barriers to entry. There have been increasing market frictions. But if we want great pricing, if we want great access to capital, if we want great entrepreneurs, leading the charge, and we want economic growth and discovery, we have to figure out what these structural shifts mean and how to best have conversations with everyone from policymakers to the general public, understanding what the sense or the pulse on the market is. And where are those gaps and those holes? And so, when we think about financial innovation comes out of gaps, holes, and structural issues. And that's the exciting thing, right? That's what gets me all fired up every morning thinking about this stuff. But when we think about the shift, and I'll pitch this one back to you, Pat. Is the shift, I've used the words to describe it, of financialization, because I've done a lot of research on financialization of commodity markets. And what that means is really the establishment of a illiquid or an asset class that had a barrier to entry, now being opened up as a viable asset class. So for those students in the room, when you think about from a portfolio theory construct, this would be a slice of your portfolio. And it would give you access to different assets with a different risk return structure than the other assets in your portfolio. And so, when Pat was talking about access to capital from a, investor perspective, that's at the heart of it. But we could also just call it democratization. Right. Do you talk us through how we should think about this, and what are some of those major structural barriers or trade-offs that you see? Robinhood Ventures just launched their first fund, right. And how is that structure helping to
absolutely
move this forward?
One of the ways that I would always used to think of private equity, and this is kind of how I think about it today, and some of the problems that we're solving, is it's not the product itself, it's the plumbing behind it. What I mean by that is it could be anything from financial reporting to a liquidity. Like, who are you going to sell? It's like buying a classic car. Yeah, it's worth something to somebody, but it's going to take a whole lot longer to get out. For the students, I also call them Hotel California trades. You can come, but you can never go. So that's how I think about these things. And so it is a plumbing problem. But I think things like your company, AI, we're getting that out there. I think there's also, how do you better invest in this? You mentioned Robinhood Ventures. So we just had our RBI Fund 1. That's separate than the RHF brokerage piece, but that allows individual investors to be able to invest in some of those companies I was mentioning earlier and start to participate. I think you're going to continue to see changes in the marketplace. I would love it to be, it doesn't have to be the most sophisticated person that can pump $2 million in. If you wanted right now to go buy some shares of Anthropic or SpaceX, you would be paying, I think it's coming down, but everybody called it 2 and 20. You're going to pay 2% and you're going to give up 20% of your returns. I think it's come down a little bit to 1 and 15 or 1 and 20, but it's still horrific. And I think you're going to see that fee structure start to be compressed. I think and my hope is, why couldn't an advisor, if this is part of, what I would say the top of your investing pyramid, something that you're passionate about, something that can fit your overall investment risk objectives, why wouldn't we allow some ownership in there? So I think there's a vast number of ways that this market could open up and allow people to get engaged with this that I think is going to fix the plumbing. Tokenization is another way that I know the SEC is looking at. I know that everybody's very interested in. That could break down, you have to have, we want you to buy $2 million of this, when you can break it up into little pieces. So I think the plumbers are coming. I love to think Robinhood is part of that plumbing truck that's showing up to try and help that, because in my vision, like I said at the beginning, if you're passionate about Anthropic, if you can do the research, if you can leverage AI to get all these tools, you can really manage that risk. You can understand what you're buying, and I think there's plenty of ways that we can deliver and fix that.
I think it's also important to note that when you're going back to your point about portfolio theory, right? The whole goal is to come up with a variety of different assets that their returns are not correlated. They move separately, they move independently. And historically, what we've seen is that private markets move independently from public securities, public stocks, as well as public bonds. So there is some real indication that from a portfolio perspective, it is beneficial to have access to some of these private markets.
Yeah, that's a great point. And the return distribution, like Pat talked about at the beginning, is substantial. So cutting off access to that return distribution is essentially widening the gap between those who can participate and those who can't. And I talk to people all the time who are like, oh yeah, when I started investing in private equity, I just kind of like fudged a little bit and kind of tried to prove that, yeah, I had those resources, but I really didn't have it. And I was just thinking, wow, that's an interesting approach to get access to capital. But I think there are some concerns, right? There are some concerns, like we do have AI, we do have, we have the internet. That's dating me, but that did not exist really fully when I was in college. So there was a lot more opacity, especially in private markets, because we didn't have access to resources. We didn't have, just the vast amount of knowledge at our fingertips. We were going to the stacks at the library to look up, company codes to do our market research. So how do you guys really feel technology has played a role in opening up, and again, Charles, going back to you, like you being that intermediary that is really providing information and context that can be validated. How is that going to help kind of overcome some of these scary or uncertain aspects of allowing the masses to invest in private markets?
Yeah, I think the institutions that we've been investing through have played by a set of rules that helps people try to understand risk. So you talk about how opaque that is, or how locked that has been up to this point. What we're seeing with technology, and not that it's the panacea, because you have to have structure for it. It's the work we do with Gallup, as you know. And the structure that I'm talking about is that when we understand what we're going to invest in, and we can trust the data, the entire format or environment for investment changes. And what I mean by that is, up until, let's just even say a couple years ago, you needed a fund manager to even get access. And you had to trust the fund manager more than the business. And that's sort of where we are still today. We're trusting this person that's managing this fund, or managing the public markets in some cases. And that's why venture capital and private equity have had a lock on this, and why it's been so incredibly one-sided for investors. If you're a high net worth individual, or if you have the way to get an institutional investment in place, you had the mechanism to do that. But last week we were up in Westminster at the Angel Capital Association. There's 14,000 registered investors in an association called Angel Capital. I call them poker buddies. It's where you each put in like 50 grand, and pretty soon you got 5 people, and you got $250,000 fund. And they take it very serious. They take it very serious as we were there. Peter Walker from Carta was with us there. And what's changing very quickly is what information you can get about that private company that you couldn't get before. The questions you can ask, the patience you can have. And you don't have to go through a fund manager to actually put money in motion, in play. You can understand it better, you can help them better. Just looking at the faces in here today, there's so much help that you could give in addition to your money if you had access to the company, but you can't do that through a fund manager. You're sitting there outside the fence. So my hope on the technology side, especially with our scoring system, is we start that conversation, first of all, with trusted facts and data. We have longitudinal data, not survey data. That means for you students in the room, we can see literally years of patterns inside of a company. And with pattern identification and data science we have today, I can predict the next 12 months of that company really, really accurately. Would you like to know that before you invest? Would the company like to know that before they ask for your capital? Are they ready for your capital? That's all literally right before us right now. So what I think is going to happen, I hope is going to happen, is what you guys started. You broke the plate, which I'm so proud of you for doing this, but democratization means that we're finally grabbing some of the ownership from that locked cabinet for venture capital, private equity, all the big important people that were there. We couldn't get access, we were just the little people. Now we get access, and now we can grow our businesses. And we might not need 50 million in capital, we might need 500,000. And that's been the other problem with this, with the process of, with the opacity of it, is nobody wants to invest 500,000 because it costs a VC company too much money to place it. So they're like, yeah, sorry, unless you need $5 million, I'm not interested in your business, but you don't need 5 million, you need 500,000, you need it today, and you could double the size of your company as a result of it. So I am so excited at where the technology is today. I realize there's risks. I got all that part. We've built an agent called Trudy. Trudy's pretty special. She's multi-agent. She can answer a bunch of your questions in your business. But I'm watching this unfold, and I'm watching people get capital that they couldn't get before in real time. And you guys kind of broke the plate for that. So I'm really, the whole democratization has got to continue. We've got to take this wave and go with it for those of us that are not in the upper echelon of investment. So.
I think it's important that, and what you're talking about is bringing it to not just that we have access to the same investments that the VCs have been making for decades, because the reason they're looking for those return profiles I mentioned before is that somewhere between 8 or 9 out of 10 of their investments goes to zero typically. They lose all of the money. And so that's why the SEC created these rules, is to protect us as the small investors,
right.
Because you had to write, usually if they're very early stage, a minimum of a $50,000 check. When they get bigger, yeah, you're in the much bigger numbers. And so as retail investors, I couldn't make the 20 different small bets that I would have to make in order to have enough investments that something was likely to give me a return. Now, as we start to look at different investments, and when we get access to data, such as through TrueSpace, it's not those same companies that we're investing in. It opens up capital to a whole different range of companies that are much more the core of our economy, that are going to double in size, triple in size, 5x, that aren't going to do the unicorns and really aren't going to become the household names. So I agree, it starts up there, but then it needs to trickle all the way down to how do we, as community, move capital into the businesses that are in our community and going to make our lives better.
Yeah, I think one theme that keeps ringing through this is sophistication. I think Robinhood sees it, but wealth does not equal sophistication.
For sure.
And this rule likes to say wealth is sophistication. And I've been at Robinhood 5.5 years, and I can tell you I've seen some of the bigger accounts not be sophisticated at all, and some of our smallest accounts have the most sophisticated and tuned to knowledge. They understand what they're getting into, and so I don't think this is about shifting risk or dumping the 19 out of 20. This is having a way to allow people to show that they're sophisticated, to show that they understand what they're investing in, to show that they understand some of these risks and, you know, give them structure like you set up to be able to evaluate that.
Yeah.
And then, you know, give them that empowerment to go out and make decisions for their families. And I think that's what this is all about, and give them that access.
Yeah.
And the scale of it is an interesting new idea,
Yeah.
right? So scale used to be find 4 unicorns, throw your money into it, and you make a 1,000x return. And the limit of that is there's still less than 1,000 unicorns worldwide, right? So you just think about how limited that is. But scale for me is there's 2 to 3 to 4 million companies that you could get access to today that might give you a 3 to 4x return at a much lower risk.
Mm-hmm.
And we've never been able to engage that because we didn't have the technology for it. We didn't have a chance to get all of that stuff together. And that's my hope, is that we can finally pull that together and we can see those companies and we can invest in them.
Yeah.
So anyway, sorry, one of the companies that always rings true to me is we were involved in the NFL Alumni Association through the Better Business Bureau. It's a group that we had down in Austin, Texas. And the NFL alumni are those football players. Most of them were not famous. They were the right tackle that blew out his knee on the first game, but still could retire. And then they start businesses. There's 11,000 businesses started from this association. And even they can't get capital. I mean, they can't call up, you know, some famous quarterback and say, hey, could you throw $1 million into my business? But what you see in there is we met an individual there that has a dog grooming business in Austin, Texas. And you think, oh, a dog grooming business, that's ridiculous. And he's doing $17 million in revenues per year, $8.5 million in EBITDA, and can't get capital to get more trucks. Now, he could buy it himself. He could go reinvest in his business, but can't get anybody's attention. So what does he do? The doodle world, those of you that might have a doodle.
I have a toy poodle, so I
They
believe
have
the
to
17 million.
they have to get groomed every 6 to 8
It's
weeks.
the doodle tax.
And you put them on a thing, and before you know it, you have a repeatable business model, and all you need is groomers and trucks. And so, yeah, it's not a unicorn, but it's an investment that you'd probably get 3 to 5x return on the exit. So,
Right.
anyway, sorry, I'm representing.
So PE's the reason I'm spending $150 on a 6-pound poodle.
Yes.
Got it. You got it.
And by the way, that's the perfect play. Right? That's the perfect. Yeah, you should see that coming. That's why it's a brand new truck coming.
There you go.
Well, I mean, I think the framework that you guys have really just so eloquently established is really, you know, and putting my regulatory hat on, because I was at the regulatory agency for 8 years, you know, government is there to protect society from themselves, right? At the end of the day, that is why we have policymakers, that is why we have laws, that is why we have government, is really to protect society from itself. But oftentimes we have these archaic rules where, you know, ultimately the accredited investor rule came into play, you know, essentially because they don't want Americans to become destitute, right? So, but what's so interesting, and Pat, you kind of spoke to this, is that oftentimes wealth does not equal sophistication. And in fact, when I teach financial literacy, I talk about the fact that, you know, a dollar is actually worth different amounts to different people. And I think that is so important to think about in this perspective, because a dollar to someone who has $10 million is nothing. A dollar to someone who has $10 is huge. And so the time and the effort and the sophistication that will go into ensuring that they are making sound investments is actually the opposite of the framework that is sort of set up to support, because they're going to do the homework and they have access to resources where they can actually do this research, and we see them doing this research now. So if we were to move in the direction that I think all of us on the stage are hoping we move, which is away from this wealth-based standard, what should count as evidence that someone is prepared to take on these risks? And how does this redefine the landscape of opportunity, which we've sort of been talking about, but really from an educational and investor protection standpoint? Like, you guys take us through what we should be thinking about, because I think at the foundational level for all of us, and for all of us in this room, we want to make sure that we have really well-educated investors, because democratization is great, But if you don't have the education to go along with it, that's where, government should step in, because we need to save our society from themselves. But I don't see that as being where we're at right now.
Yeah, I guess I'll start. I believe education is the center of all this. I think that is the road to sophistication. Like I said, I've seen all different walks of life, and that person with 30 grand to their name, they're going to take so much care of $1,000 investment and do so much research and turn the world inside out, different than somebody with $30 million. You see it all day long. And so for me, what I would like to see is less of a government chaperone and more of a know your customer, know your customer's education. Are they qualified? Do they have the skill set and the ability to do the type of research? I think that alone should unlock doors for people to have access to these markets. And it's very easy nowadays, candidly, with smart contracts. It's almost like, did this happen, then this is okay. Did this happen, then this is okay. And I'd love to see a world where it's like, hey, here's Charles, here's this KYC stuff, here's his experience in the marketplace, here's how long he's been investing, here's something to show that he understands the risks, and here this shows he is sophisticated. I mean, maybe somebody could just say, do they have access to Claude, and that's good enough. But in all seriousness, I think it's being able to show that they have the aptitude and that they have the skill set to do this type of research, to understand what your company's putting out. And then I think from there, they have some responsibility as well.
Yeah. I think it centers around a standard.
Yep.
So that's where we got connected to you guys, is that we've built a standard. It's a performance standard that's, again, longitudinal for a business's performance. And the reason I think we need a standard first, Naomi, is that you have to be investable before you can get the investors involved. And I think in the private markets, that hasn't been the case. I hear people that are growing their businesses and they say we need capital. And you go, well, how do you know you need capital? Well, we need capital. We want to invest in this and this and this, and we want to add some more people. And you're like, well, how do you know you need capital? Let's go back and really look at it. So we've been able to build a graduated measurement system that shows whether you're at a standard. And what the standard is really doing is it's saying, first and foremost, you're capable of using new capital. It's a capability index. That is paired then with your financial performance over the last 12 months. So we put those two pieces together. It's mind-blowing what we can do with 12 months of your financial P&L and your current balance sheet. I can get 22 really important pieces of information that become predictive. So get to a standard. Let's get a standard developed. It's something that we're trying to do this year. And when you have a scoring system that has a standard, you're either above it or below it. We call it being scale ready. And if you're scale ready, you're probably ready to have a conversation with a capital provider. Then to your point is exactly right. Let's educate the investors to understand what does that mean. And then you'll see the flow change. The flow will literally go a little bit both ways. And we won't have these frustrating things that you've seen in your capital where people aren't really ready for it. And they get it and they blow it and they don't use it for growth. And you've seen all those things, unfortunately, that take place. But if we could come up with a standard that we could trust and we could measure it with the fidelity that's available in our technology today, I think it would totally change the flow of capital from investors to business owners.
Yeah, and I like that we're talking about what is the standard on both sides, because I do think that just looking at what is the standard for an investor is probably insufficient, because there are lots of wonderful, really charismatic entrepreneurs that can sell people and convince them to invest in businesses that are probably a terrible idea. And sophistication, like a lot of the data is out there at the same point. Do you really understand the lockup of investing in a private company? And you may not have access to that capital for 5, 7, 10, 12 years. And so I can understand the fundamentals, and I can see that it's a good business and maybe it grows really well, but I still, am I in a position where I can be parted from my money for that amount of time? And so making sure that we're aligning both the investor sophistication with the business alignment so that those investments are really suited to them I think is an important aspect to this in terms of like some of the specific standards. It's really hard to say. I think like most of the the financial series tests, the CFA, some of the things that have been thrown out thus far are probably a really high bar for people to meet. So it probably does have to be in an alternative, custom developed standard on the investor side. So yeah, I don't know what that specific test is, but I do think it's important that we look at both sides of it.
Yeah.
I think the punchline here is a healthy amount of friction, but not just arbitrarily blocking people out.
Yeah.
You know?
Right.
Yeah.
I think John kind of got at this, but there's a famous paper in finance called The Market for Lemons. And essentially that paper is establishing, using the used car market as a mechanism to talk about, incentive problems with private companies and with entrepreneurs. And I think that that's something that, that framework has been well established since the dawn of time. It's one of the seminal papers that if you go and get a PhD in finance, you're going to read that paper. But I think that it sort of gets at this, notion of what you talked about, Charles, is like, okay, yeah, an entrepreneur with a great suit and a great, elevator pitch could potentially position themselves as being healthier than they actually are. And, in the used car framework, it's like, you go to sell your car and you're like, somebody's going to ask you, has this car ever been into an accident? And you're going to say no. Does it have any mechanical problems? No. It's perfect, right? And we know that no company, just like no car, is perfect. There are always going to be little things. There are going to be, we sold my daughter's car this weekend, and my husband looked at me and said, her car smells like ketchup. And well, that is no longer our problem.
I'm not such a...
So but when you think about a company, just like a used car that might have, a McDonald's ketchup packet spilled out under the seat, it really is important to look at the framework around both the investor education, but also, what are the disclosure statements? What is the, how do companies like TrueSpace really kind of come in?
Well, I think there's probably an increasing level of reporting that should be required as companies are growing. And a lot of that data is available. So like the companies that Robinhood Ventures is investing in, we look at the SpaceX and the Anthropics of the world, tons of data out there. When we look at the dog grooming business, not a lot of data out there, right? And so how does that evolve over time, I think is a really interesting aspect of this.
Yeah, and it will be iterative. So thinking about it from a retail investor perspective, and John, you touched a little bit on this in terms of money being locked up for a long period of time. So for the students in the room that may have a Roth or a 401k, or they don't have any of that, there's a lot of conversation in this space about do we open up private markets not only on platforms like Robinhood, but to allow for us to put our 401k dollars and invest those dollars in the private space. But from a liquidity perspective, what are the advantages and what are the kind of risks associated with that avenue?
Yeah, so when we think about the capital that I'm investing in my typical brokerage account that I want to put in the stock market, I don't need it today, I want it to grow. Maybe I'm saving for a house, for a car, for something in the near future. I want to make sure that I can get that cash back as soon as I need to purchase something. And so that's why I put it in public markets, because within a day, within a couple days potentially, I can get that cash back out and spend it as I see fit. Who knows what it's going to do in the meantime, may go up or go down, but I know that I can get access to it. And when we look at the private accounts, private investments, typically those are holding for 12 years where you don't have any access to that money. And so as I sit and look at myself, I've got more than 12 years before I retire. And so my brokerage account is probably not a great place for me to make some of these investments. But my retirement is going to sit there, and probably I'm not going, maybe I rebalance it every quarter, rebalance it every year, but I'm not actively trading in my retirement accounts. And so it's a really good place to go park money that can sit there for an extended period of time. So again, when we take that overall portfolio perspective and we look at how much of my retirement account should I have in public markets, in growth equity, in emerging markets, in in large caps and small caps, in bonds. Adding another asset class that's uncorrelated makes perfect sense and improves my overall returns over that longer time horizon.
Yep.
So to me, the retirement accounts are the perfect place to do this, even though right now that's the place that they're kind of restricting.
Right.
And
right.
for me, part of the overall suitability, I think everybody, for anything, should take into account your goals. When do you need that money? For the youngsters out there, my CFP will tell you, hey, you know, you need to have at least 3 months worth of savings, 6 months if you're single or single income. And I think in no way, if you need that money in 6 months, would you ever put it in there. I always like to think of the classic car example. I never thought I'd buy one. I just had my midlife crisis and bought one with a cool V8 in it. But it's very similar. It's worth something. If I need that money today, though, I'm going to have to take a hit. I always tell people it's always worth something, but if you have a liquidity need, you're going to take a major haircut, especially with a private investment. And so not only is it liquidity, but another thing that you don't get as often is price discovery. So on the public markets, price discovery is happening every millisecond. Apple's changing, what the value is. Anthropic, the other A company that we all love, I have no idea what that is from day to day. And so that's just one more thing. You're not going to know how your net worth is changing up and down. I don't know what my 73 Bronco is worth day to day, but it's just going to go back and forth. And so you have to keep in mind, what are your goals? What kind of risk are you willing to take on in that account or for that bucket of money? That goes to your overall objectives, and it all really plays together. So I don't think this is about shipping something and saying, congrats, everybody, go grab what you want. I do think there's a lot of very important considerations that people should be taking when they're thinking about private investments.
Mm-hmm.
Yeah, I think we're advocating a couple things for around liquidity. I saw the question, I really liked it. So we're talking about liquidity for investors. So we have all this information working with Gallup, almost too much, but I'm going to share a little bit with you. As we sit here today, there's 33 million U.S. firms in the U.S., registered LLCs, S Corps, C Corps. There's only 6 million of the 33 million that have more than 5 employees. Of the 6 million, there's only 178,000 firms in total, including all the big ones, that have more than 10 million in revenues. So just think about how quickly this goes down to this piece. But those companies, of the 178 to say 200,000 companies, are incredibly interesting from an investment perspective. And I think we keep looking at them as equity investments, which are really locked up. So the average business to get to 10 million in the United States takes 12 years. Imagine those of you in the business school walking into a venture and your PowerPoint presentation says, and in 12 years we're going to get to 10 million. But that's the reality. That's the reality of what John was talking about. So we think that this new mechanism we have with both the standard and the measurement would open up debt instruments. Mm-hmm. And debt it becomes liquid on a term. I think there's less risk involved. And imagine if you have money today in your savings accounts locked up, maybe retirement 401ks or whatever, and you could get 8 to 10% return over the next 4 years on an investment in a business that you know about that's met a standard. We can open up a whole new realm of capital for small businesses today. Mm-hmm. And because we keep looking over that as if that's too much risk, and yet we take this risk with equity. Mm-hmm. Mm-hmm. And this is less risk. Usually you're in the top stack, you have to go below a bank. But many of us, even in this room, would be interested in those types of investments. So I think what we're going to see, speaking of democratization, is private debt is going to get a new life because it can now see things it couldn't see before.
Yeah. That's fascinating. Sort of shifting gears a little because we've got about 15 minutes, and then I promise we'll open up for questions. When we think about this sort of institutional construction, how do we balance that broader access with genuine investor protection? We've talked a little bit about it, but we really haven't gotten into the nuts and bolts of like what are the regulators in DC really sitting here really worried about, and how can we sort of serve as a partner in terms of academia and, from a founder's perspective, from a publicly traded company perspective, what should we be talking about in these spaces around regulatory reform, around policy, around, where these things really should go?
Let's start that in.
So
I talk a lot.
So we're going to end with regulation. We're going to talk about.
Well, I'm a regulator,
I know, I'm just-
regulatory scholar, so you got to
I mean,
bear with me.
I mean, for me, on the retail brokerage side, I think you can look in other areas and already see some of the blueprint there. If you come in and want to trade, uncovered options at any brokerage firm, they're going to make sure you have the education. They're going to make sure you have the experience. They're going to make sure, some of the financial background is there. None of it touches $1 million, and that's an antiquated number. Like, none of it touches any of that. So I think some of the groundwork is already there to show due diligence, to show that you know your customer. KYC's been around for a long time. You all probably see it on annoying emails once or twice a year from whatever brokerage you may use, but we have a requirement to understand who is doing business with our firm. And I think it's very simple. You don't even have to reach far to start bringing that together to say, okay, what is their background? What is their education? What is their experience? What is their ability to handle risk? And then allow that to open things up. And you can, like I said before, this isn't opening up the floodgates and saying, sweet, Robinhood ships something. It's providing access to markets in a responsible way. And I think there's a really healthy middle ground.
I think that there's nuance is the key from a regulation standpoint. It's not you happen to hit the $1 million mark and now you can invest in any public markets or any private markets. And if you were $1 less, you can't use any of your net worth, but now suddenly you could throw all of your net worth into these private markets. Like, that probably doesn't make sense. And so a gradated standard, as well as more specific alignment with the type of security, because again, there are still some extremely risky things that we want a pretty high standard to get into, or you probably want the protection of a fund manager in many cases. Whereas there are other things like investing in the Anthropics of the world, where there's lots of data out there that is probably a much lower threshold. And with some of the work that they've done, you no longer need the big checks to get in. Now, if I can put $100, $250 into an investment, then that opens the door and de-risks it dramatically. So I think that taking a more nuanced view based on the real risk and the sophistication of the investors.
Right.
I think we need smart regulations. I mean, when you know the rules, you can play the game, right? And I think we need those. Our own research over the last 15 years, the carnage we've seen with friends and family investments, we need some oversight there that doesn't exist today. And it's hard to watch when you have a company potentially that fails or can't get the return, the promises they made to people that they trusted, and there was a trust relationship but not a trust in the business. I'd like to see something in that realm that goes down lower than because you can float below that, the regulations today. So I'd love to see that. Frankly, what I'd like to see is just a real commonsensical conversation in Washington about private markets, because they all play the public game, right? They know them, they can see it, they can invest, there's information, there's data. But I'd love to see them just finally just turn their head and start looking at how important the private market is, especially with the trend that we started this with, and more companies are actually going from public to private. And
Right. Yeah.
so anyway, sans that, I don't want any regulations, but.
But I think that it is important, right? It's important to kind of think about, and as a financial educator, and someone who has seen the way that financial education can actually completely transform multi-generational poverty across our country. I think that this framework and this opening up of different asset classes really calls into question just the baseline financial education that every American deserves to have, right? It is truly. It should be a right, it should not be a privilege, because so much of what we see in the lack of education, it leads to health disparities. It leads to a lack of forward progression in terms of career and goal setting.
Right.
So I think if we start thinking about what is that framework that we want every American to have, and it should be a baseline level of financial literacy, I think that we're looking at education transforming not only access to capital from the entrepreneur's perspective, but we're also just completely transforming people's lives
That's
and their
right.
livelihood and their outlook and their perspective and how they view the world and risk and everything else. And Pat, I love the fact that you kind of framed this midlife crisis vehicle that you purchased, because when we think about the liquidity and the opacity around private markets, I mean, we hold illiquid assets. We all hold illiquid assets, right? I mean, in finance we like to call them alternative investments, but we have people that have huge wine collections. We have people that invest in art and sculptures. We all want the American dream is to own a home. Homes are not liquid. Right? So, I mean, this is sort of, setting the stage for really just thinking about this as, yes, this is a part of your overall portfolio, and yes, it is an illiquid part of your portfolio, but we hold assets all the time. We sign contracts all the time for, hundreds of thousands of dollars that we are paying back in this debt structure that really are lending itself to us having that money locked up. I mean, the number one asset that most Americans have is their home. But they're not going to, they still need a place to live, right? There's a source and a use and a purpose to all of that. So before we open up the floor to questions, maybe each one of you can kind of run down what is the most important thing you want this audience to understand or go research about investing in private markets.
I guess I'll start. I mean, for me, this is just kind of a tagline that I tell everybody, whether it's investing, managing, anything, it's not about eliminating risk, it's about managing risk. I think, anytime you make an investment, you're taking on risk. It's on every single financial commercial. Just like a drug company, they're going to make sure everybody's aware of that, and that's always going to be there. And so for me, it's about managing risk, and you manage that risk through knowledge. I like the Warren Buffett, like invest in what you know. I think it's invest in what you like, love, and know. I think through that alone, you can start, you're not going to have the snake oil guy pushing, like, look at this sick company I have a building over here. You really know the product, you use the product, and you understand it. And then from there, there's no such thing as a stupid question, especially with Claude or ChatGPT. Literally, the world is there. Even private companies, you can get pretty good reads on cash flows, on balance sheets, on debt and the debt structure. But just, push yourself. I think it is always about managing risk. Always think to yourself, if I can't get this for 14 years, because that's what private investments are holding on to right now, or if I can't, if I need to take a little bit of a loss here, how much is that going to impact me? So I think always having a plan, have a plan to manage that risk. And I think that's the one thing I'd like to see.
Yeah, and I think that probably the private markets are going to be, if you pay attention, are probably safer bets than the public markets, because those of you that have had stocks, you should know that the public businesses know all the rules and they report things based on what they can and can't do. So my encouragement and our work at TrueSpace is to try to develop a standard for private companies. And by doing so, we change the transparency of understanding the business, the risk, your involvement in it, and so forth. And I think that's really what I want to be able to do. But I also want, the thing I talked about a few minutes ago, it's not always an equity investment. Look at other ways you can invest. Some of these companies could easily use debt. It's fast, it's quick, it doesn't take as long, it's not as restrictive, but the risk is lower, and you can actually get a return that's sensible. It's not maybe a 5x or 1,000x on your return, but it's something you can fully understand. So I also think my final word is that we're just getting started. I think the technology, if we can use it wisely, but it is literally the thing that we saw with the internet. When it comes to discrimination and others, the internet gave access to so many people. I think now, and this is thanks for the people at Robinhood as well, But democratization of all this finally gets us all in the game. And I can't imagine anybody in this room that doesn't want to see a business succeed, because when they do, they create jobs. Job creation is literally the essence of this entirety of what we're really talking about at the end of the day. So I'm bullish. I'm excited. Well, I'm still scared to death, but I'm excited about what's possible, I guess, based on where we are today.
Awesome.
Nice. Yeah, I would say get started. It's similar to where AI is at today, right? Like, you can read books about AI, but the only way you actually get to understand it is to dive in and start using it. And so dive in, like, start looking at private investments. You now have access to them in ways that you never before did.
Well said.
That's awesome. Look at some of those opportunities. Meanwhile, there's great groups out there for more of the direct private investments. Rocky's Venture Club just down the road is the oldest angel investing group in the country. Get involved, start learning about that type of investment so that you can see the full spectrum. If you're a student here, we have the Pioneer Venture Fund, which is a student-managed venture investment group where we make private investments. Like, come get involved, and you'll start learning about it in ways that you never would if you just sit on the sidelines.
Awesome. And I think it matters too. Charles, you brought up technology, where we see the job creation as we start to see people lose their jobs because of AI. It really is in this entrepreneurial space. People are going to be starting their own companies. People are going to be building businesses. And so there's going to be a market need on the other side of this for even greater allocation of capital. And so I think that it's definitely coming, and it's really it's exciting to see, and it's exciting to just be a part of this conversation around what should we be establishing? How should we all be working together? How should we be having these conversations? So along those lines, I'll open the floor up for a few questions. Thanks, Kate.
Yeah, we can hear you.
Yeah,
we can hear you.
They won't on the recording, but
Oh, we'll repeat it for the recording.
okay.
Well, my first question was, what do you guys think about the SIE, the Security Industry Essentials exam, as a qualification for retail investors? No sponsorship required.
Yep.
Pretty basic. Maybe we revise it, change the name to add something about a little more about private credit, private.
Happy to take that. For the recording, he asked, what do we think about the SIE? So a little bit brief history for those that don't know. In order to be like a stockbroker, typically you had to have either your 6 or your Series 7. Series 7 is like the most common brokerage that allows you to transact in equities, options, mutual funds, that sort of thing. So the SIE, as this gentleman alluded to, it is kind of a pretest. Nobody needs to be sponsored. In the old days, you needed to be sponsored by a firm to be able to then go out and get your FINRA Series 7, so then you could transact for them. But now there's a way for anybody to go out and take the FINRA SIE exam. I think that is just one more piece of evidence on how somebody can be sophisticated. I believe the SEC or I think it was the lawmakers were putting together, if you had your Series 7, your Series 99, if you knew enough, that made you sophisticated. I don't see why the SIE would be any different. We hire brilliant young people all day long, and we have them go through, and I would say that's fair to say, hey, you're pretty sophisticated. But again, I don't think any of this is binary. I don't think it's, hey, one thing occurs. Just like managing risk in an investment, you're not just going to look, hey, did this person sell it to me really cool? Do I like what they're doing? You're going to look at a lot of different things. You're going to look at financials. You're going to look at background. You're going to look at how long have they been doing these things. And I think it's just one more piece of the greater picture. Anytime in life, in my opinion, you start to go down a yes-no binary, there's always going to be gray area. That's the beauty of this species. So I don't think anything should be approached in black and white. Go ahead.
Mac?
Did you have a mic, or I can repeat it? I'm loud enough.
Yeah.
Go ahead.
Let's suppose you convince me now that I want to be investing in the private markets. So how is that going to happen? How am I going to invest in the private markets? And how am I going to feel comfortable about investing in some things that I don't necessarily have the public information on those?
go.
Yeah.
I mean, I think it depends on what type of private investment you're trying to get into, right? So if we're the best, another one of those subjective things.
The hot stock.
The hot stock, exactly. And so I think that, again, it depends what type of investments you want to get into. If you want to, get into a private placement with an early stage company, you need to go get to know the founder, get to know the team, do all of the due diligence that a typical VC or a private investor would, the stuff that we go through in PVG. I think that now, through things like Robinhood Ventures Fund, now you can invest, you can go on it, and there is a publicly traded closed-end fund that you can go and buy shares and get access to the returns of some of these household name private companies.
Yeah, and what I would say to that, number one, I would never want to convince anybody of what to invest in, honestly. I think, we should really go back to the fundamentals of how does this fit into my goals? How does this fit into my overall picture? Yep. So if you were so moved and said, you know what, there is one of these companies that I'm interested in, I do think that's the crux of this conversation is right now, candidly, a lot of people are locked out. And as an American, I hate to see that because it leaves so much opportunity on the table. So like I said, you'd either have to talk to the founder and get in early enough because the SEC will shut out investors at a pretty low level if you're not accredited. Once it moves to accreditation state, that's where I was talking about the 2 and 20, where you're going to pay 2% annually, you're going to pay 20% of essentially your cut of the returns. Thank you for mentioning Robinhood Ventures. I did not prompt him for that, but that is just one more way. I know back in the day they would want all investors in that fund to be accredited. So you're starting to see the tides change. There's going to be other methods, I believe, coming down. There's a lot of, if talk about Googling and looking up GPT stuff like tokenization. I think tokenization is going to be one of the great pipes to deliver some of this. So maybe in your position, you don't want to risk $2 million, which may be the buy-in for one of these companies. Tokenization will shatter that to pieces, and maybe all you can risk is $100, but you want part of that because you believe in it. And that's going to be another opportunity. And I think all of these are pieces of the dominoes that I think we're seeing start to fall. So I hope that helps. I think right now there's not many ways that what I would classify as a younger non-high net worth investor to be able to partake in it. And I think it's a travesty.
It depends a little bit on how much time you want to spend.
Yeah.
Is it a passive or an active investment? You got to kind of figure out, are you going to spend time to really do the due diligence to understand it? If you are, there's a lot of mechanisms across the country today, syndication with friends, developing your own angel investment group, possibly going into a public instrument that Robinhood has created where you can get access to private companies. So there's all kinds of ways you can do it, assuming that's what you want to do. But if you want a passive investment where you just put money in and wait for a return, there aren't a lot of places for you. If you want to be active, you want to be involved, manage it, then I think there's multiple places that you could get involved. So, in fact, we could even give you a list of that if you're interested in those things. Yeah. So it depends. To me, it depends on where you're investing. Why do you want to invest? Is it active, passive? Are you involved or not? And then you can start taking some routes kind of through there. But passive investment is exactly what you said. It's been so restrictive. It's for certain people, special people, I guess. But for the rest of us, there's a lot of different ways to do it.
Yeah, and I mean, I think too, when we think back to, the good old days where you literally had to pick up your phone and call your stockbroker and they're going to charge you $85 to make a trade, to, when we started to see mutual funds come into the picture, and then we had ETFs. I actually think that this access to these markets is going to create a whole nother, discovery process, and advisors are going to come in and they're going to form portfolios of these companies that are going to have different tranches based off of, the prediction that TrueSpace can offer in terms of, lowering down the opacity, but I think it will also create, they do this in private equity firms already. They look at what the liquidity structure is. They look at when they want to sell off these companies, when they want to return the distributions, and I think that more and more really smart people are going to enter in, and more companies are going to enter in that serve as that sort of intermediary to create that framework, would be my perspective on it too. So innovation, spurring innovation is always fun. Way back there in the back.
Good evening, everyone. My name is Suleiman Kamara. Thank you for hosting this event for us. I have a question about entrepreneurship, probably two in one. So you had mentioned that a lot of entrepreneurs will say that they need financing, but they have no idea whether or not they are qualified to get finance or why they want financing.
Yes.
So can you speak into that? What can they do to know that they are ready for that kind of thing? And a lot of time, too, when entrepreneurs start their journey, they're really not thinking about financing. So what can they do at the get-go to make sure that when that day comes, they are ready for financing?
Suleiman, I think you answered, your last question was part of the answer. You have to build a business that is capable of using capital that's not generated from the operation itself. So you're talking about growth or operating capital. So what we can help you understand, and you can do this yourself, but really understand what it is your business is trying to produce, and what outside capital would do to help that. What we see on the converse of that, which is part of my answer to your question, is people think capital will solve their growth problems. If I just had more capital, we could grow. And that is just a falsehood. You've got to be very specific of what you're going to do with that capital. Is it more marketing? Is it a different team? What is it? What's the specificity behind it? And not to get into, but it creates a unit economic condition in your business where you can see how the capital is actually used. So it's probably for another discussion, but that's what we can see. But you asked the right question. You have to start with this in mind. And there's three forms of capital in our mind. Your business will produce capital. There's debt financing, and there's equity financing. And you've got to look at those things in a completely different way. So you're on the right track, though, if you're asking the question.
Yeah. The other thing I would add to that is understanding those different types of capital and where you can find them, because back to your friend with a dog grooming business, despite that level of EBITDA, it's still really hard to get a bank loan.
That's right.
And so understanding what each of those investors is looking for and what they're expecting before they're going to give you that capital. Because that's one of the things that we saw in our research is entrepreneurs are starting businesses believing that the capital markets are out there to fund them, even if they do understand how they're going to use that capital and how that's going to drive growth. But oftentimes, because of the friction we've been talking about at the earliest stages, the capital markets aren't efficient, and that capital isn't necessarily going to flow, especially if you can't produce the types of returns that are going to entice a venture capitalist, and you can't show that you've reduced the risk enough to convince a bank that their money's safe.
One.
Pat, this may be a question for you. I'm curious about the Robinhood Venture Fund. What's unique about it that allows retail investors access to the private markets, and should I expect more funds similar to this to pop up in the future?
So, yeah, great question. The second part first, yeah, we've been public about the intention to continue to evaluate companies and look at other funds. What's unique to the venture fund is we're talking a lot about the structure tonight, the evaluating the finances, the evaluating, what I would say is the quality of businesses they're in. So you have fund manager that is doing a lot of that work and that diligence on your behalf. That's kind of the main thing. Also, it's 11 labs. Those that, and I'm not pitching any particular company here. It's just one that through one of my side businesses I've been playing with, incredible company that I've started to see how it can translate text into Speech with AI. Really cool stuff, but that's what it even opens up to me. No way was I gonna have the time. I've had a storied career, but look, I'm not of that level where I'm gonna go in and get in some round of funding at one of these companies, but that allows a regular investor like me to have access to that. So that has already started today. So when I allude to, you know, a couple of years ago, we would have all been locked out of that unless you were accredited. That's what I'm talking about, is we've started to open the doors. We're really excited about that opportunity, not only for, you know, our investors, but, you know, all the up and coming people that haven't even invested in the market, for them to walk in this new space that we didn't have access to growing up and started to invest. Like, that's what it'll be. So can't share too much, but more to come, and we're very excited about what Robinhood Ventures is doing. Yeah.
Yeah, awesome. Well, we're out of time for questions, but we have a reception over in the main Daniels building in Marcus Commons, so we can continue the conversation over there and hopefully answer some more of the questions in a more you know, one-on-one conversation. Just want to thank Robinhood for your support and for bringing this event to Daniels and to the University of Denver. We're really excited to begin this series of thought partnership around some of the most pressing issues in our nation. I do want to mention for all of you in the room, we are ending this week with our Sustainable Business Symposium, so I want to extend the invitation to all of you for that. And if you're interested in attending, we can certainly get you the invitation if you need more details. But want to just thank all of you for being here. It's been a great conversation. I think we've covered a lot of ground, a lot of territory.
Yeah.
Thank you to my panelists for joining me tonight, and you know, let's go have a glass of wine or a beer and enjoy the conversation continuing. Thank you all.
Thank you. Thank you, guys.